And on today's show, why life insurance can make sense for college planning. Part 3 of this week's series on life insurance income strategies with life insurance income strategist Don Prehn, CLU, ChFC. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to InsMark, Life Specs, and Backroom Technician. Let's get down to business. Well, welcome to the show.
Hey,
Don,
Steve.
I appreciate it. Day 3, wow.
Yeah, day 3.
Well, we're talking today about college planning, and there's a lot of debate on the web, whether we can use life insurance for college planning or not. And we need a timeline issue here. That's a timeline. How much time do I have to play? But we're going to show you an example here, and especially because we're focusing on our little gals going to college. This is a huge issue because our entire society has changed, and now we want to make sure we're accommodating this. Talk to us about this couple named Tom and Kristen and their 2 children.
Sure. And what we're going to start off with this case is this is a new client. They maybe don't know us very well. We're just kind of getting involved in sort of what they're trying to do with their children, what their concerns are. And this is a great way to sort of start the relationship. Here we have Tom and Kristen Scott. They're 40 and 35. They have 2 daughters, Daisy and Jody, who are 10 and 8. And the first thing that we wanted to talk with them about is, let's make sure we have enough death benefit, term or whatever we decide to get. Let's make sure we have enough death benefit so that if something happens to the parents, the kids have plenty of money to go to college. And so here you'll see in this table, starting in year 8, we have $30,000 a year for Daisy for 6 years, 4 years undergrad, 2 years graduate school. And we have the same thing for Jody, who's 8 years old, so it starts out in year 10. So $180,000 for Daisy and $180,000 for Jody, and then here's your total, $360,000. And so the question becomes, how much life insurance do we need to fund these income needs at the death of the parents, starting out here in year 8? And Steve, if you can, here's the analysis of that. Again, here's the educational funds desired. And what we see, assuming a 5% interest rate, is we need $257,000 in term or some other death benefit so that if the parents were to die, there'd be enough money to fund those educational needs.
For both children.
For both children. So that's sort of the first analysis that we did to sort of explain the time use of money and needs analysis and how that might work. One question that came up, though, was, what about inflation? And with educational costs, we've seen inflation running at 6 to 7%. So we put a 4% inflation factor. You could clearly go higher. And so with inflation, you can see there's the $30,000 a year inflated. And now we do the same analysis. We click over on the next tab. And you can see that with the inflation factor, the numbers get a little bit higher. And then we find that we need $404,000 of death benefit to fund those college costs for both daughters with inflation.
Now, just a quick note.
Sure.
And you can plug in whatever number, like you said, maybe if it's 7, you can show realistic numbers. We're just doing a conservative 4 just to show where we can go. But really, you can display any of this.
We showed 4% because we didn't want the client to feel like we were trying to, boost up the death benefit need. We're saying, look, college costs have been running at 6 to 7. We'll use any inflation rate you want. We used 4 just to be conservative. We certainly could use a higher inflation rate.
Okay.
So that was sort of the initial discussion with the client about how we could use life insurance to protect funding for the 2 girls going to school. And that turned into the next discussion. Well, why don't we do a more comprehensive analysis, including not only the financial needs if something were to happen to the parents, not just for college costs, but for everything, and also include the assets that they currently have. So this turned into a more comprehensive survivor needs analysis. So here we have $25,000 for final expenses, $25,000 for an emergency fund. It turned into a bigger discussion. $25,000 to upgrade their home. They wanted to pay off the mortgage if something happened to them for the girls. $30,000 of income for the next 15 years, and then the college costs we discussed. So we did a little bit more sophisticated survivor needs analysis, and let's look and see. This turned into, here you have our financial goals. This is a more, not just an educational needs analysis, but this is a whole survivor needs analysis where we include the assets and benefits they have, the cash flow needed, and here you can see we needed $497,000 of death benefit to really take care of that entire survivor needs analysis problem. And then the last illustration that we ran is assuming we bought that extra $497,000 of life insurance, we plugged that in as an additional asset, And as you can see, by plugging in that additional death benefit, the additional asset required was zero.
Okay, now this is really, I loved your idea because a lot of people, you're approaching a client for the first time.
That's right.
So first contact interviews are really a huge issue, and you're trying to develop trust.
Right.
You're showing college first, but really in the deeper planning, most of us want to be a good planner, a good advisor. We're going to incorporate all the scenarios, and you've done that in this idea. And I like the idea of now that I have this extra death benefit, not only for college, but for all my in-game expenses that could occur if both mom and dad died, then I'm looking at a zero-sum expense load. I've really covered all my options, all the alternatives that could happen with a two-death scenario.
Yeah, and you're making a really good point. What we want to do is show the client that we have a great ability to analyze their financial situation.
When we come back from the break, we're going to do that very thing. We're going to incorporate retirement and college planning. We'll be right back after the commercial. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, I'm with life insurance income strategist Don Prehn. Don, we talked about college planning in the first. We're really going to up our game here a little bit. Not only talk about college, but do kind of full comprehension. You know, a lot of the information that I've seen out on the web lately, articles and blogs, are talking about adults having to pay college tuition and trying to put retirement monies aside. And sometimes it's very difficult. But a lot of it has to do with tax strategies that could really keep more money in your pocket. Let's walk through your case study here because this is illuminating.
Sure. Yeah, in the last segment, we talked about death benefit funding college costs. In this plan, we're going to use a product called Wealthy and Wise to put all the client's assets into the program and then account for any income needs they have, including educational needs and retirement. And the program will then analyze everything in the most optimal way. So here, in this particular case, we have the Callahans, Tony and Jennifer, age 45 and 40, and then they have 2 children. And so as you see down here, what we're going to show is these are the college costs, assuming the parents live. These are the college costs for Mark and Aaron, starting out in 8 years and 10 years, and here's the total amount with inflation. And then what we're now going to look at is what are the assets of this family. And this is all plugged into the software program. And so you'll see they have $500,000 of equity assets, $500,000 of taxable assets, $250,000 of tax exempt, retirement plan, residence, and so on. So a total net worth of just over $2 million. So we plug all that in. It accounts for the college costs that need to come out. It accounts for the retirement income that they want starting at age 65. And then what the program does is say, okay, based on the assets you have and the assumptions in the future, this is sort of the status quo of what's going to happen with your overall wealth plan over time. And as you can see, they were able to fund the college costs and their need for retirement, and they end up here at age 95 and 90 with total net worth of about $5 million. And you see how their net worth grows and then kind of levels off.
Now I noticed that you knocked this out. I like the yellow because it kind of says, this is the net equity of illiquid assets, right? Things I can't really play with. Then I have my retirement plan assets in this rather teal, and then your dark blue using your taxable assets, and then tax exempt in this regular blue, and then this kind of pink or maybe a lavender color. I don't know if that's the right color, but that really graphs. Sometimes the graph really shows you a picture that really can give you an idea because people are very visual. Can I look at this other thing that we're going to look at now? Yeah,
so this is strategy 1, which is the status quo about their current assets, how they would grow, and their need for income. Now, strategy 2 is where they take $100,000 a year for 5 years, and they reallocate that from current investments into a cash value life insurance policy. And here you can see the policy. You have the $100,000 a year 5 pay, and then starting at age 65, we start taking retirement income out.
So this is going to take care of college and my retirement.
Well, this is simply a reallocation of $100,000 a year 5 pay into a cash value policy that we're then going to integrate into the overall Wealthy and Wise analysis and see where we end up. The income for college and the income for retirement will come from the overall group of assets. And the income coming out of the policy will be income coming into the overall wealth plan of the client. So it's all aggregated, all part of that. So if we look at strategy 2, you'll see that by reallocating $500,000, $100,000 5-pay into a policy, our net worth grows from $5 million to $17 million. That's the power of reallocating those assets into a cash value life insurance policy over time.
And is that causing this huge increase directly? Is the life insurance causing this increase?
It's the only change we made, and the answer is yes. And so if we compare strategy 1 versus strategy 2 in the Wealthy and Wise comprehensive wealth analysis, you see that if we do nothing and leave assets where they are and just kind of go along and take money out for college and retirement, we end up with $5 million. If we reallocate $500,000 into the cash value life insurance policy, our net worth grows to $17 million. And that's the only change we made.
That's the only change.
Correct.
And so this death benefit at the end game of whatever their mortality is, life expectancy, this is a huge spread between 5 and 17 million. I mean, that difference over time is huge.
It's huge. And here, as you can see, under the status quo plan, the income and college costs coming out over the lifetime, $14,200,000. With our plan, $15,100,000, more than the extra $500,000 that went in the policy. The next thing that we wanted to show, which is strategy 3, is we wanted to show if we wanted to increase the income and not worry about building this giant net worth. Here you can see that with the policy, with the Wealthy and Wise plan that included the life insurance, we only have $6 million, which was just a little bit more than their status quo plan. But look how much more income we can take during their lifetime. We can take $19 million, almost $19 million, versus their status quo plan of only $14 million.
And this is not building the assets now, it's just generating more income.
Yeah, the client said, well, gee, that's great that we generate so much more income, but can we generate more income during retirement and keep the net worth kind of the same as our current plan? How much more could we get? And this graph shows, well, you can get another $4 or $5 million over the lifetime of the client.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just go out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant, and we'll see you tomorrow.